Okay, hello guys, and welcome. This is the Actuarial guy, and today we'll be talking about one of the most interesting subjects of the Actuarial curriculum, that is subject CD5 contingencies. And all CD5 is about is something called as the life insurance mathematics. Okay, so we'll be discussing the mathematics that actuaries use. Uh, when they work for life insurance companies. Okay, so let's start discussing by that. What is the role of an actuary in a life insurance company? Okay, so that is the first question that we need to address before starting with the syllabus overview. In order to understand what our role is in a life insurance company, the thing we need to understand is how a life insurance company operates. So I'll give you a basic model of how a life insurance company operates. Let's say this is a life insurance company and it has a contract with a lot of policy holders. So it has multiple policy holders here. Okay, and with each of these policy holders, what this life insurance company is doing, it is undertaking some risk of theirs. So the life insurance company is undertaking a risk of the policy holder, and it is undertaking this risk and it is pooling up this risk uh, in exchange of something that is called as a premium. So in exchange of undertaking some risk of these policy holders, the life insurance company charges a premium. Okay, and this premium, it is an amount. It may be a single premium, a single amount, or it may be monthly payments, or it may be an annual payment. Okay, so it can be any one of these, and this is the cost of the risk which is undertaken by a life insurance company. So what kind of a contract can exist between a life insurance company and a policy holder? Let's take an example. Okay, so let's say with this policy holder, the life insurance company has a contract that whenever he dies, let's say this guy, he is aged 20. Okay, he's aged 20 years, and the life insurance company is contracting with him that whenever he dies, he will receive an amount of 1 million pounds. Okay, so that is the contract that is taking place between the policy holder and the life insurance company here. Okay, um, so this kind of a contract, it is generally known as a whole life assurance contract. We will be discussing about the types of contracts later in the videos. But for now, I want you to know that this is called as a whole life assurance contract because there is no time limit on it, and whenever he dies, he would be paid a claim of 1 million pounds. Okay, so right, where do we come in? Where does an actuary come in such a contract? That is what we need to understand now. So an actuary is basically appointed by this life insurance company here. Okay, the actuary is an employee of the life insurance company, and what he does for the life insurance company are the following things. Okay, the first thing that he does is he values these risks taken by the life insurance company. Okay, so he values these risks and he tells the life insurance company that what is the amount of the premium that the life insurance company should charge for undertaking these risks. So this kind of a job is called as the pricing of a life insurance contract. So what an actuary does is he prices a life insurance contract for a life insurance company, right? So that is the first thing that we do. We tell them what is the amount of premium that they should charge. Okay. The second job of an actuary is called as reserving. So what reserving means, let's understand this. Let's take example of this contract itself. So the life insurance company was was undertaking a risk of this policyholder to pay him 1 million pounds whenever he dies, right? So whenever this guy dies, he'll be receiving a payment of 1 million pounds. But if I talk about the chances of him dying, right? If I talk about chances here, uh, he can die at the age of 20. He can die at the age of 21, 22, and so on and so forth. He can die up till the age of maybe let's say the maximum human age is 100. It is denoted by omega. Let's assume that he can die going from 20 to 100 at any age. Okay, but the probability of him dying at ages 20 and let's say at the extreme age 100, it won't be the same. The probability of dying would be low at the age of 20 and it would be really really high uh, at the age of 100, and at the age of let's say 50 it would be medium as compared to these two. Okay, so it would be less than what it would have been at 100, but it would be more than what it is at 20. Okay, um, so this probability of dying keeps on increasing. So for a life insurance company, now there is not one policy holder, there are thousands and thousands of policy holders. Okay, and it has to pay claims to all of these policyholders, and the number of claims, the number of payout keeps on increasing with the ages of the policyholders. So maybe in the initial years there would be a low payout, okay, on a bunch of policies, on a portfolio of policies, that is what we call it, it is a portfolio of policies. There would be a low payout, but later the payout would increase, so I've got a high payout later on. Okay, but the premiums, if I compare this with the premiums generally are level. That is, they are constant. Okay, so even if I am receiving a premium of £10,000 every year, it would be the same. It would remain constant. Okay, so wouldn't it make sense to for the life insurance company to pull up these premiums and then keep these premiums as a reserve with themselves for future liabilities, because future liabilities are going to be higher and we know that, and current liabilities are lower. So as the liabilities keep on increasing, the life insurance company wants to be prudent and it wants to pull up its present incomes in order to pay its future liabilities. So this amount of reserve, it is determined by the actuary based on the probabilities that when and how a person would when a person would die, right? So that is the second job of an actuary, and it is called as reserving. Okay, let's talk about the third job. Okay, the third job is called as profit testing. So what profit testing means is that we need to charge some amount of profit on these policies too. So initially, when the actuary prices these policies, they price it without profit, and then later on, the life insurance company gives them a certain profit criteria, that is the amount of desired profit, and accordingly um, the terms of the policies, they are manipulated and they are repriced. Okay, so combined all these activities, we are doing the back end function of a life insurance company, and what we generally do um, is called as product development for a life insurance company. So we develop their products. Okay, and that is what actuaries do. um okay, so this is the job that we need to do, and this is what the curriculum for subject CD5 is based on. Now I would be discussing the overview of the subject with you, like whatever is covered with in each of the chapters. Okay, so I'm gonna proceed with that. Okay, we have got chapter 1, 2, and 3, which are the basics.
Here we'll be discussing the various types of contracts 1, 2, 3, and even 4. These are the basics. We'll be discussing life insurance contracts, what is their nature, what kind of symbols we'll be using to price them, uh, to deal with them, and what our methods would be, what kind of tools we'll be using. So there'll be life insurance contracts, there'll be life annuity contracts, because payments can be continuous too, one after other. I can make let's say 20 payments to a guy who survives for a certain term. So I can make a payment of 1 lakh to him each year, right? So there are life annuity contracts, and then we'll be discussing the life table in the third chapter. Will be where we'll be discussing the probabilities of whether a life survives or dies, and what are the chances. So we'll be making a table and we'll be discussing it through graphs. Very interesting things here. If we get to chapter 5, 6, and 7, here we will be discussing premiums, the calculation of premiums and reserves. Okay, so this is what we'll be discussing, and after this, if when we are done with the 5, 6, and 7, then we'll get to chapter 8 and 9. Okay, chapter 8 and 9 basically cover joint lives. Basically what will happen here is that instead of having one life to whom we have issued a policy, we'll be dealing with policies with more than one people, basically two people. So two people, two related parties would be here, and the contracts would be such that a certain amount of money is paid to life 1 when life 2 dies. So when life 2 is dead, life 1 will be getting a payment. Let's say for example, there's a couple, a husband and a wife. So when the husband dies, the wife gets a payment. So this is the kind of policy, because in many of the countries ladies do not earn. So just to give them some sort of financial security, these kinds of policies were designed. And there can be business partners who can take these policies, there can be brothers, there can be children who would be the beneficiary in case of their parents die. So these kinds of policies would be discussed in this section. If I talk about chapter 10, this comprises of competing risks. So far we have just talked about the risk of death. Now there will be more risks to a particular population. If I talk about a person, he can get sick, they can get let's say they can exit a population by getting married, they can retire, a couple of other things that can happen to a person. Okay, and the probability of a sick person dying is different from that of a healthy person dying. And same goes for married people. Married people are less likely to die as compared to single people or bachelors. I'll get to this later. I'll tell you why that happens. That is a very interesting fact, that it has been observed that married people are much less likely to die as compared to single people. Okay, so that is something very interesting. We'll get to that. uh, After that, these things can happen to people. So these risks exist, okay, in a population, and they compete to kick out a healthy population, a healthy person out of the population. So these risks basically compete with each other. So that's why they are called as competing risks. And this chapter requires a certain background from subject CD4, which even if you haven't passed, I will be discussing the basics which are required from CD4 to here, so that you do not struggle with this very interesting chapter. Chapter 11 deals with the pension funds. I did not ever like this topic. This is Like this is something out of the line which is formed here. Like these all chapter, they seem to belong here. This chapter is totally different and unrelated to all the above chapters, although it has some links to competing risks. But then it is a very weird chapter, but it is easy, so we'll be discussing it in detail. This is something students struggle with, so this is some struggle, there is some sadness about it. Okay, and then we get back to the normal contracts we had been discussing, since we had last left them in chapter 5, 6, and 7. Then we had started with the joint life, so we'll get to single life contracts again in chapter number 12 and 13, where we'll be doing profit testing and reserving for these contracts. So we'll be doing profit testing and reserving all over again. So these two chapters, they're very interesting, loads of calculation, loads of tables, and you will need to use your intuitive aptitude. So there's a lot of understanding and everything with these chapters. And the last chapter, chapter 14, is mortality, selection, and well, it is, and I don't, and there are summary measures. Okay, so this is the last chapter, mortality, selection. Here, this is a theoretical chapter, theory. We'll be discussing some theory related to life insurance and pension contracts, and it's a very scoring chapter, and it is interesting and not boring at all, and you don't need to learn the theory. That is the beauty of actuarial science, you just need to intuitive. So yeah guys, that was all about our curriculum. Now I will be discussing something which is really important, that is links of CD5 of CD5 to other CD subjects. So if I talk about CD5 in general, how is it related to CD1, CD3, and what kind of a background you need in this subject? I'll tell you a simple formula. Okay, we are actuaries, mathematics people, we understand formulas. CD1 plus CD3 is simply equal to CD5. Now you'll ask me how is CD1 and CD3 equal to CD5 added together. I'll tell you something very simple. What CD1 dealt with was basically interest. In general, we dealt with discounting, and accumulation. CD3 dealt with probabilities. That is, in general, we dealt with expectations and variances. In CD5, we are discussing life insurance mathematics. Here we'll be pricing and reserving insurance contracts. Now, if you think about an insurance contract, there is a life. Let's talk about this in a bit detail. Okay, yeah. So if I talk about a life insurance contract, as I did earlier, there is a life insurance company and there is a policy holder. And the life insurance company pays to the policyholder a claim amount. This is uncertain, that is, it can be paid payable 1 year later, it might be payable 2 years later, it might be payable 3 years hence, and it might not be payable at all if there is, let's say, there is an assurance contract and the policy holder survives till the end of the term. So then there is no liability, and in exchange, the policyholder pays premiums to the company, and if these are generally, these are monthly or annual premiums, and these might also be uncertain, because for example, if the policyholder dies after 1 year in a 5 year contract, then he'll only be paying 1/5 of the total premium. So there is an element of uncertainty attached to it. Also, these amounts, they will be received by the insurance company. These premiums will be receivable by the insurance company in the future, and claims will be payable in the future. These are inflows for the companies, and these are outflows. Okay, so they are future payments which need discounting, hence we need subject CD1. So as this involves discounting, and as they involve an element of uncertainty, that is probabilities, we need subject CD1 and we need subject CD3. So if I talk about subject CD5, it is a combination of these two subjects. Okay, that is why I say CD5 is equal to CD1 plus CD3. But it is not necessary that you should have necessarily cleared this subject in advance before you appear for CD5, because these things, probabilities, expectations and uncertainties, you must have learned them at some school level. Okay, you must have learned them in your school while you were, graduating there. So you must have learned these topics, and these are simple topics, so we do not need the CD3 subject in very detail. If you have passed CD1, you can appear for CD5 and it won't be a problem for you at all. One more knowledge CD5 requires is from subject CD4, as I told you about chapter 10, competing risks. And that is because the thing is that with life insurance contracts, there is a thing called as force of mortality. Okay, force of mortality is similar to subject CD1's force of interest. It is denoted by mu, force of mortality. We'll be discussing this in detail. Okay, so this is something which is a CD4 thing. Okay, but again, studying CD4 is not necessary. I'll give you all the background that is needed for you to study CD5. Okay, so you can be rest assured that all you need is to have cleared or studied subject CD1. Okay, so here, that is the deal. Let's see. Okay, so what will we be talking about in this subject CD5? You must remember from subject CD1 that we discussed something called as an equation of value there. The equation of value in subject CD1 said that the present value of outflows must be equal to the present value of inflows, and this is what we followed in subject CD1. What subject CD5 says is something very similar, but with probabilities attached to these present values. So subject CD5 says that expected present value of outflows must be equal to expected present values of inflows. how do we calculate these expected present values is a subject of interest. So I will be briefing you about it right now. um, See, if I try to calculate present values, what do? I just take the amounts, whatever amounts I'll be receiving or in the future, and I multiply it by the discounting factor. Okay, and I multiply these two things and I add all the amounts and I get the present value of outflows or inflows. Same thing. But here, the thing is that there are probabilities attached to these things. Okay, so since there are probabilities attached to these things and these are uncertain quantities, we will also be multiplying probabilities of these payments. This is something like, you can think of it as calculating the mean. Okay, the formula for mean or expected value, expectation, which we call expectation, you must have learned this in subject CD3, is sum of x into this is for a discrete series, x into probability of x summed over all the values of x. Okay, so this is your mean. Similarly, as I'm calculating the expected present value here, the formula changes just a bit. It would be sum into amount, that is x, into the discounting factor, which I need to multiply because these are future amounts, into probability of x summed over all the values of x. So this is how it all functions, and that is how CD5 is related to subject CD1 and CD3. And so yeah guys, this was all for the trial, and I hope you enjoyed the introduction to the subject. I will be making a full course on subject CD5 on teachable.com. I will share the link to that in the it's just right below this video. I hope you liked it, and like, comment, subscribe, like all the YouTubers say, and tell your friends about me. And if I hope you I don't know, buy my course. Thank you, and this was Romit, the actuarial guy.